Manmohan Sharma is the kind of investor who invests in small cap funds with the belief that they will give better returns. However, after 1 year, his returns were not as per his expectations. His daughter Kalindi, who is an active investor, came home during holidays. Sharma discussed this with Kalindi. He was concerned that he did not get the expected return. Sharma asked her what to do. He told her that his friend Gupta stated that investing in small cap mutual funds can give good returns quickly. Kalindi explained that small cap funds have higher risk. Now Sharma was concerned and he started discussing whether to withdraw money from high risk funds like small cap and invest them in large cap funds. Kalindi also agreed with it and said that it would be appropriate as a small cap fund is better for young investors as those investors can stay invested for 5 to 7 years and they can wither from the high volatility in the market.
You might also get confused regarding which is better, small cap or large cap. First of all, let us understand what is a small cap or a large cap fund. As per SEBI guidelines, in large cap funds, 80% of the investments are done in large caps. Similarly, small cap funds should put 65% of their corpus in small cap shares. In large cap funds, it can be noticed that investment is generally done in selected industrial sectors, specifically in the company with good track record.
So, if you remember, in 2017, SEBI had come up with a product categorization circular. That circular was very clear and it defined very well how the fund manager is supposed to manage a particular fund. And in that circular, it was very clearly defined what you call a large cap, what you call a small cap. As per that regulation, it was very clear that any company which has a total market capitalization between in the range of first to 100, they will be categorized as a large cap. And any company which is like 250 and beyond in terms of total market capitalization will be considered as a small cap fund, right? Small cap stocks. Now let's talk of these funds, right? Large cap funds will only invest into this set of universe, and small cap fund will only invest into that particular universe which is beyond 250. Large cap funds are purely a blue chip play, right? So they have seen the market cycle, they have been in the industry for a very long time, they have seen all the ups and downs, they have a big customer base, they have a big large business. For example, I can give you maybe a Reliance or HDFC Bank or HDFC Limited, right? Those are termed as large cap companies. Those are pure blue chip. They are basically, you can call them the darlings of the market, right? When it comes to the small cap category, these are the firms which have recently started their business. They are in the very initial stage of their life cycle, right? In the entire business cycle, they are not that big, right? But they have the opportunity. Frankly, if you're investing in something, it has to have that opportunity. So they have that opportunity, but they are very small companies. So they may not have experienced the entire business cycle. They may have not grown so big, right? But they have the capability of becoming the large cap of tomorrow. That's why you invest. You're capturing an opportunity in the early stage of the life cycle. So these are your different types of. So this is basically a difference between a large cap and a small cap. And the funds who invest into this are called as large cap fund and a small cap.
Such companies have a strong presence due to good growth and better financial performance. Generally, these companies give good returns to shareholders. They get the benefit of compounding and they also give regular dividends. As compared to small cap funds, there is a lower risk in large cap funds. If an investor has a lower risk appetite, then he can invest in large cap funds and get a stable return over the long term. This means these funds have long-term investment horizons. On the other hand, small cap funds invest in companies that are small and entered the market recently. These funds have high risk and huge volatility. Any noise in the market impacts these shares very intensely. But on the positive side, if these companies grow, then investors in the small cap funds get impressive returns. So we can say that large cap shares have more stability, but small cap funds have higher volatility. Therefore, investors should make a decision of investing in small cap funds based on risk appetite and their investment horizon.
Now let us look at small cap and large cap funds based on returns. As per Value Research, in the last 3, 5 and 10 years, large cap mutual funds have given returns of 13%, 11% and 12% respectively. On the other hand, small cap mutual funds have given returns of 24%, 12% and 19% respectively in 3, 5 and 10 years. So, we can see that small cap funds have given better returns than large cap funds. Overall, we can say that both small cap and large cap funds are better from a long-term perspective. But in the long term, small cap funds generally give better returns.
Speaking of net asset under management of these funds, AUM of small cap funds have increased 23% while that of large cap has increased 7%. Small cap funds generally attract youth, specifically looking at the fact that millennials are becoming more financially aware.
So when it comes to mutual fund, every mutual fund type has a different risk associated with this, right? That's why SEBI has made it very clear when you're talking about any fund, you need to tell what kind of risk parameter does that fund fall in. So when I have to just draw a risk parameter, a large cap fund would be relatively lower volatile, lower risky than a small cap fund. So I'm doing a relative comparison, right? So because obviously, and when it comes to a small cap fund, they're obviously more volatile. Okay, they have the opportunity of giving you a multiplier return, right? That's the added advantage that you get. But when it comes to return or when it comes to risk, it has high risk, high return kind of a category when it comes to small cap. Now the question is, where should one invest? Ideally, as an advisor or as a firm, what we strongly believe is anybody who's investing should invest basis their risk appetite. Maybe your risk appetite will be very different from my risk appetite, right? So that's why I have to be very sure. Okay, if I want to participate in the small cap rally, okay, then I should be able to take that risk because there will be volatility, because markets will be volatile, right? So there will be volatility in that category. If you're okay to sail through the volatility, then you should look at the small cap category funds. But if you say, I don't want to take that kind of a risk, right? I would want to be in a relatively safer environment, a relatively safer industry, then the option is obviously the large cap category. But at the end of the day, it purely depends on what is your risk taking ability as an investor. What is your investment objective? If that also meets the goal, then you should look at these two categories. Frankly, there's no right or wrong category. Both are good. Okay, both will give you a return in line with the benchmark or in how the fund managers are managing in that. But it purely depends on your risk-taking ability, right?
For effective investment diversification, it is important to understand market capital. If large cap funds in your portfolio is performing poorly, then a small cap fund can perform better. Similarly, during high volatility in small cap funds, large cap funds can give you stability. Hence, it is better to have a diversified portfolio. This helps your portfolio in terms of market volatility. But before investing, you should be clear about your financial goal, what is the risk appetite, and your investment horizon.